What's up, guys? This is Carter Thomas with Coin Mastery TV. Welcome back. Happy Thursday. It's good to see you all. Make sure you hit that subscribe button, hit the thumbs up button, all that good stuff. Thank you for joining me. Now, today we're doing a little different for a few reasons. The first is that I did a poll, as I talked about on Monday, where we asked people what they wanted to see, and macro was probably the biggest thing. So we're going to start with that today. Just see what people like. Secondly, as a marketer, a lot of people drop off the videos about halfway through, which is normal on YouTube videos, a little different for the podcasts. But hopefully that we can keep this engaging enough that you stay longer and you watch it and you rewind and you watch different parts again. And obviously everyone's busy, so I don't expect you to sit there and watch a video for 20 or 30, whatever minutes, so 30 minutes. So I figured we'd just try this. We'll see what happens, and then we'll go from there. We're going to talk a little bit about Amazon. I posted this morning. Talk about the U.S. stock market, the dollar index, volatility index of the stock market of the S&P 500. What's going on with some of these emerging market currencies, specifically Argentina. Talk obviously about Bitcoin and the price of Bitcoin, and then we're going to kind of go from there. Really macro heavy today, and then we'll, like I said, we'll just kind of bounce from there. Cool. All right, great. So the first thing I want to talk about is Amazon. Now, the thing that's on everyone's mind, and I tweeted about this, how the stock market, in my opinion, is not U.S. stock market is not really going to stop being the place that money goes to, as long as these governments, these currencies around the world keep failing. So you're seeing Turkey, Argentina, Venezuela. Brazil's kind of on the teetering on it right now. South Africa is kind of teetering on it. You may start seeing some of these other, like Chile's kind of teetering on it. And you start to see these things happen with Italy. We saw it with Greece before, Iceland way back in the day. And as this starts to happen, capital flows. There's not a whole lot of places to flow, because typically what happens is that money flows into very, very secure assets, which is historically governments. But the problem is that if this crisis, let's call it a crisis, as it unfolds over the next 3 to 5 years, is actually a currency crisis, which is a government crisis, a fiat currency issued by governments. You can't necessarily put money into the public sector, which is bonds and treasuries and government debt. You have to, or the money is going to flow into the private sector. And even though they're publicly traded stocks, private sector means like it's a company, it's a business, not necessarily VC. And that is kind of the thesis of all of this. Now, obviously, anything can happen. You never really know. And it doesn't mean it's just going to keep going straight up for forever. It's obviously going to have retracements up and down and bouncing around, and maybe even consolidation, kind of what we've been seeing with the S&P 500 over the last 8 months, right? Where it's just kind of bounced, and then it came back, and now it's at all-time highs, and we saw it back in 2015. But I think that we will see strength in this, because it's not that the U.S. economy or the U.S. stock market, U.S. economy are different, obviously, but the U.S. stock market, it's not that it's like good or everything is great and there's no problems. It just means that it's got less problems than everybody else, and money it has to go somewhere. It always has to be parked somewhere. And it's always going to go to the asset class that is either the safest or the one with the growth. So anyway, starting with that kind of framework of macro, of the big picture here, looking into a company like Amazon. So I posted this. This is a weekly chart of Amazon on the NASDAQ. It went public in 97? IPO'd in 93, or founded in 93, I believe, but it actually went public in 97. And you can see it famously kind of had this big run up in the dot-com bubble, huge crash back down. Move myself over so you guys can see some prices if you're watching. And you can see, $8 up to almost 110, back down to 14. And then the rest is history, not including any sort of dividends or not dividends, but like, I don't know if they have any stock splits. Maybe they did. But if not, it's trading. It just crossed 2,000. It's at 2017 right now. There's a little bit of a delay on this, but So it's just something to think about. Now, the comparison that a lot of people make is they look at this and they're like, man, this is obviously parabolic. Let's compare it to Bitcoin. And while it is parabolic and maybe it's not sustainable, it's completely different than Bitcoin, all right? Because it has different fundamentals behind it. It has different revenue models. It has different profit margins. And it has different competitive landscapes. It has the ability to suck in different amounts of money than Bitcoin is because it has growth numbers that can, on some level, justify it. And when you look at any sort of price, especially in this kind of, not kind of like a post-truth world, if you want to call it, but this has always been the case. Valuations, as they are related to any asset class, especially stock market, is really just a way for everybody to agree on a price. So when you look at a balance sheet, or a profit and loss statement, or an earnings report, or a Q10 or a 10K, or any of these things that companies put out, it is purely a way for people to all say, this is what it's worth, or this is what I believe it's worth. And that's what drives this price. And some people would say, well, it's overvalued. Some people say it's undervalued, but the price is the price. Whereas on Bitcoin or any crypto asset, especially last year, it was almost impossible for people to agree on what it was worth. And so what it was worth was completely determined by market speculation. That's why it was a true bubble, because it was built on game theory. It was built on who's going to, someone going to buy it on top of what you're buying it on. And as we create a bigger ecosystem, when we can justify those valuations where more people agree, the narratives start to consolidate. That's when you get stability. So first and foremost, I think that's the first thing that's different, right? This is obviously a weekly chart versus maybe a daily chart on Bitcoin, but the time frames is less of an issue. It's more of just what we're looking at. Because when you think about this, it's almost a chart of just like how much money it's sucking out of, like department stores or retail shops or even small businesses, right? And I'm not, by no means am I like saying, oh yeah, Amazon's the best, go corporate. I get it, right? But what I am saying is that this is a very good representation of a trend of consumer behavior, people putting money and believing in this company and actually using it, as opposed to something like Bitcoin, which was a bubble that was built on speculation on what it could be, not what it necessarily is. And that's up for debate. But I think that that's a good exercise to go through, is to understand there are obviously different parabolic moves. And yes, this is obviously going to retrace in some way at some point. And when you zoom in a little bit, you can see that it retraces along the way, but it's still having these massive weekly expansion bars for the most part. And if the entire economy takes a dive, Amazon's obviously going to go down with it because people are going to buy less, and it gets pulled down by the index and speculators, everything else. But that's something to keep in mind as you're looking and as you're evaluating any sort of investment, where you're at. One, how you evaluate how you determine the valuation, how the narrative is being talked about. I think that's probably the biggest one, right? Now let's go over to the S&P 500. The S&P 500, kind of along the same lines, is in many ways it is having all-time highs. And people are saying, this is the biggest bull run in history. Now, the thing is, I think it was 2011 right here. If we go to April 2011 and we go down to the bottom, and I'm not, this isn't exact because I can't quite get in there. It says it's 22%. It was like a 19%, 19.6% retracement, or pullback, I should say. And the technical definition of a recession is 20%. That is 100% arbitrary. Someone just decided at some point, hey, look, 20%, if it hits that number, we're in a recession. If it's 19.99, we're not in a recession. That's why people are saying this is the longest bull run in history, when in fact, there have been multiple pullbacks that are in the ballpark of 20%. One was 19, this one, 15%. Along the way, it's not like it's just been straight up. And so when you think about it that way, all of a sudden you start to realize that, hey, maybe there actually is a lot more runway here because that 20% number is just a headline. It's not necessarily the full story. So something to keep in mind. The other thing to keep in mind is, kind of push back on my own logic here. If I don't know if this is going to have a blow off top or anything else. One scenario that I keep coming back to that I think is very possible is this idea that, especially people, like if you're, I would say 50% of the viewers of Coin Mastery are under the age of 35 based on analytics and everything else. And I would say 80% are under the age of 50. And I think that lends itself to these two big bubbles, the 2000 bubble and the 2007 bubble. And what happened with both of these is that in the 2007 bubble, it was a fast and severe drop. You can go on YouTube and type in futures market flash crash 2007. You can just watch the thing go completely crazy. And S&P 500 doesn't really do justice in 2000. Go on the NASDAQ charts, it's obviously, 90% drop. And when people in that age bracket, 50 and below, when they think about recessions or crashes or whatever, we think about severe drops relatively fast, but then also have relatively quick recoveries. Okay? Like it takes, let's say, a year and a half, 2 years to fully capitulate, and then it comes back in 2-ish, 3-ish years back to the same levels. And that's the cycle, top down, top down. But when you look at history, so I'm going to go to the Dow Jones. I'm going to go to the DJI. Let's see which one is going to have the longest history here. Does this one go back to the 70s? Yeah, so if you go to the Dow Jones chart, I'm on the weekly chart for the Dow Jones, and you look at what the market looked like, basically after the war, you had this essentially parabolic run, and it never really had this huge dump and then way back up. It was kind of almost like a 10 or 15 year consolidation period where it just bounced up and down. And if you held an ETF, look at this. If you bought stocks in January of 1966 in the Dow Jones, let's say you bought an index fund, inflation aside, dividends aside, it had the same value in, let's call it 1980. So that's 14 years, and without dividends and without inflation, you're at the same level if you just hold it. That's 14 years. That is something that we are not used to we have never experienced that, people in that age bracket. I'm under the age of 50. So obviously I've never experienced it. Then you hit the 80s, 1982, I believe, is when synthetic products were really starting to be introduced. If you've ever read Liar's Poker, go read that book by Michael Lewis. It really talks about how Salomon Brothers pioneered this, or one of the pioneers, and how they sold synthetic bond. It's kind of the beginning of credit default swaps, right? Where you can package groups of real assets into synthetic products that you can then sell, and then you make massive cuts on the sale. That drove some of the biggest growth in history, like some of the craziest growth ever, which culminated obviously here in 1987 with a major crash, which was built on, it was like stock insurance, which is essentially anti-leverage, which is why you get these severe drops. So what we're seeing here, kind of big picture, Dow Jones doesn't really have as much of a severe drop, is I think a lot of people are waiting for some sort of big dump, right? Some very fast, very effective deleveraging situation. Deleveraging meaning you were in massive debt that represented value that didn't exist. Credit default swaps being the last one with the real estate bubble. Internet being, internet and options and all this crazy value that was being manufactured in the 1990s with the internet, with dot-com stuff, that just disappears because it didn't exist in the first place. That type of deleveraging happens really quickly. When you go up to where we are now, there's a case that can be made for things like student debt, auto loans, housing to a certain extent, corporate debt, not necessarily through buybacks. And buybacks are kind of a 50-50. But maybe there is something that could cause like a huge, fast deleveraging situation. But if there's no catalyst that's going to drive that, what may end up happening is that we get the similar situation like we had in the 60s and 70s, which is actually deflationary, in that what happens is that we just kind of bounce around here for the next few years, maybe 2, maybe 3, maybe 4 or 5 years, and bounce. And then something comes out. In my opinion, it's probably going to be something like security token, like you're securitizing all these like $10 trillion worth of assets, or some major breakthrough in technology, some huge new thing that adds more value, perceived value, to the economies of the global world, like in 1982, where they created all these new economic financial products, and then that drives what will be like the biggest boom ever, right? Like the Dow Jones goes to 80,000, like crazy numbers. And that to me is a situation that I believe is more viable than a huge dump and then another kind of run up, because we're running into a global situation, or even a financial situation. In my opinion, we're running out of stuff that's valuable. There's just not enough things that people can put money into. And I think that is what blockchain is going to solve. I don't necessarily think like that means go out and buy security tokens themselves. I think it means that when security tokens start securitizing assets, there will be a lot of new things you can put money into, you and every like institutions and everyone else. And that may happen in the 2020 to 2030 generation, something like that just goes completely crazy through the roof. And then with all that, you get blockchain companies themselves that have all this new technology. You have publicly traded companies that implement blockchain technology. It's going to be a huge piece of that next run. But the interim, we will see. And I think that that's all going to, play out how it plays out. Now, in the interim, you're going to have this. We're way in here. You're going to watch this whole thing happen with the U.S. dollar, right? So you can see I got some levels down here with all these big bars. I personally think that what's going to happen with this dollar, like we talked about with the U.S. dollar, is that it's going to come way back down to like 91 at some point, like between 93 and 91. And then it's going to go up to like, pull up the weekly here. I mean, it's going to go up to like 120, right? It's going to go back up to here. And this is going to be the impetus for just massive global change. It's going to be the impetus for the stock market to go absolutely crazy in a few years. And it's going to be the impetus for a whole new reorganization of currencies and governments. Because what's happening now is that even at low dollar strength, relatively low dollar strength, but with strong equity strength, on top of sovereign debt issues, you're seeing this happening in emerging markets. So I've got the chart up here for the inverse of the USD versus the Argentine peso, where you're seeing just an absolutely insane capitulation. I think it's 85% down for the year. And this is just horrifying. I mean, it's terrifying if you live in a place like Argentina or Venezuela. I can't imagine what this must be like. But this money is going to, like, this value has to go somewhere. All these people are still able to produce something. There's still all this infrastructure. There's still like established economies in these countries, and it has to move somewhere. Chances are it's going to get sucked up by equities, by the dollar, whatever it may be. So watching all of this, keeping an eye on how this goes. I personally really like watching the VIX, which is the volatility index on the S&P 500. You can zoom in pretty close on this because it's understandably very, very volatile in itself. So you can see it popping up here. But watching this is a good proxy of what's going to happen with the overall kind of crash or bouncing levels of the stock market in the U.S. So all of this together, do you see how it's like all starting to connect? I know that that's a lot of information, but you see companies like Amazon, which are being used, which are like, there's no reason why this should come down other than narrative changes. Narrative changes maybe because people are like, well, it's just too much. But that narrative may be driven because our most recent history is built on this idea of crashing and recovering, and not built on what happened in the 60s with just deflation and just like sideways action for a decade or whatever it may be, right? We have a different set of eyes looking at what we're looking at. And then it really ties into the big picture with things like security tokens and blockchain. On the other side of whatever that happens with all of this, as the catalyst for really the next major explosion in prices and value and whatever else it may be, and we'll see how that plays out with from a currency standpoint as well. Now let's kick it over to Bitcoin, which I know is why a lot of you guys are here. But I do think that this stuff is interesting because it helps you understand what's going on with Bitcoin, but also like in the grand scheme of things, assuming Bitcoin is the winner or does survive this in many ways, it like kind of nickel and diming about these prices becomes less important when you're starting to think on a 5 to 10 year window, if you believe that it will fit into this whole narrative. And so if we zoom back in, I'm going to go on the 30-minute here. You can see on Monday, I drew this chart, move myself so you guys can see the prices here. I had this green box, as you remember, and we tested it. We broke through, we kind of consolidated. There's a huge supply, like I guess you can call it a supply zone, but you can call it a big resistance, which is where this green box stops. Now we stopped a little bit lower than I expected. I guess the top of this previous resistance, right around 71.30, kind of stopped us out. And we're coming back, and you can see at this blue line, which is at 67.80 or so, which we've had these lines up for weeks and weeks. I mean, this was here really before I left for last couple of weeks. And we're coming down, we're bouncing right around there. And so you can see how these charts really just, it's not that they're predictable by any means, but they follow, once they're inside these blocks or these zones, you can call them, it'll do its thing, but the move is really going from the bottom or the top of the zone, right? And buying at the bottom of the zone and going to the top of the zone and vice versa, and not trying to predict if it's going to go in or not go in type of situation. And so we're seeing if this is going to hold. If this does hold, or if it drops back down and comes back up and it retests it, then that's, I mean, in my opinion, it's a bullish sign. I know that there's a lot of like, oh, we gotta really dump this thing. We really got to keep going. But in my opinion, you're starting to see a lot of pressure from the outside world to starting to look for new solutions. I mean, I posted the local Bitcoin data isn't up right now. The site's down for maintenance. But you know, the volume of people buying Bitcoin in Argentina has been going up as the currency has been going down. Same in Venezuela and in Turkey and things like that. Not as much as, you know, it's not like they're buying millions of dollars worth. They're buying enough to make it the trend be going in the right direction. But that changes. That actually starts to give this some value, which is the first time in a long time where we've had a story that is believable to the outside world, which is really critical. And you're also getting a lot of infrastructure being built, on-ramps, all this sort of thing. So if this 6,800 level holds, which is this blue line, give or take, that to me that's pretty interesting. And then we really just got to get above this 8,500. We get above that, and we retest it and keep going up. And then the next one's going to be the 9,900 or 10,000-ish. It's going to be, it's a good sign. It's very good. So you can see, I mean, on Monday I said I'm not going to short this, and I'm glad I didn't, because yes, you might get this kind of, you know, a 100-point thing, but to me, that risk reward isn't very good because this 6,800 is showing some pretty good support. So if I had shorted this, I don't know, it wouldn't have been very interesting in my opinion. So we're going to watch this. We're going to see what happens, and then hopefully it blasts off. You know what? And so this is the chart, by the way, of the local Bitcoin. So you can go to coin.dance if you ever want to see this data. It was down for maintenance this morning. Maybe it's up, but I'm gonna end it there because it's probably a lot of info. If you ever want to check anything out, just scroll back to the part of the video that you're interested in, and we will go from there. Like I said on Monday, one thing I will do in the next week or two is I'll do a kind of a mini series where I talk about how you can get involved in any of these other markets. Purely because I didn't know how to do it a year ago. Like if I said, okay, I want to make a bet on the S&P 500 going down, but I don't actually want to short the thing, or I don't want to sell my stock. Like if I want to buy an option or a future, how do you even go about that? And I think just knowing how to do it is important. So that'll be an ongoing process. I think you don't have to do anything. You don't have to sign up for it, but I think it will be helpful, especially as you start to realize that, these are the new, like emerging markets. You can make, this is better returns because it's all leverage. It's like 50 to 100, or some countries like 300x leverage in Forex. I mean, this is much better returns than any altcoin last year if you played your cards right. So, I mean, there's a huge opportunity. It's obviously also a lot of risk. So that's why it'll very optional, as is everything, because none of this is professional advice, as you guys well know. Cool. All right, guys. Well, I hope you have a great Thursday and rock and roll. I'll catch you guys on the flip side. Peace out.